Welcome to Unmuted Memoirs, where corporate wisdom meets real-world entrepreneurship, served with a side of truth and a mic that's always on. Today's question sounds simple, but stumps a lot of new business owners. How exactly do you pay yourself? Should you pay yourself through owner's withdrawals or a salary? Or should you just be taking money out and hoping no one asks questions? If you have felt confused about how to compensate yourself legally, strategically, and without red flags from the tax office, this episode is for you. We will break down what owner's withdrawals actually is, when a salary makes sense and when it does not, how to avoid mixing business and personal life, a bad office romance, and most importantly, how to pay yourself with clarity and confidence. Because let's be honest, if you're doing all the work, you deserve more than a mystery deposit and vibes. Hit that subscribe button, download the free Pay Yourself guide below, and let's unmute the truth about getting paid as the boss. So you started a business. You are the CEO, the administrator, the janitor, and now you are wondering how to pay yourself without triggering a tax disaster. Should you take a withdrawal or pay yourself a salary? Let's break it down into simple, smart steps and legal way. What does paying yourself actually mean? When you run a business, there is no automatic paycheck. You decide how and when to take money out. But how do you do that? How you do that depends on your business structure. If you are a sole proprietor or in a partnership, you are not technically on payroll. You pay yourself by taking a withdrawal, a transfer from your business account to your personal account. The pros to support that is that it's easy to do, no payroll software is required, and it is flexible. You can take flexible amounts. The con to that, or the disadvantage, is that tax is not withheld at source. You will need to plan for it, and it looks informal on paper. Tip: you should set aside 25% to 30% of what you withdraw for taxes. You will thank yourself later. The business salary for corporations or incorporated entities. If your business is incorporated, you can and often should put yourself on salary like a regular employee. Advantages to that is that the tax will be withheld automatically. It helps with credits, loans, RRSP contributions, and CPP contributions. It is clear, it leaves a clear paper trail. The disadvantages to that is that it must follow payroll rules. It involves remitting source deductions and CRA paperwork. It is therefore less flexible. Start small, set a salary you can sustain, and review quarterly. If you are a sole proprietor, withdrawals are the simplest mechanisms. If you're incorporated, salary can help optimize taxes, but a mix of both might be best for you. A bonus strategy for you is this. Some incorporated business owners take a base salary for consistency and dividends or withdrawals for flexibility. Talk to your accountant or talk to me to run the numbers. Common mistakes to avoid. Don't treat your business account like a piggy bank. Don't forget to set aside tax money. And don't pay yourself without tracking it. Clean records protect your business and your wallet. And there you have it. Withdrawals versus salary. 2 ways to get paid, 1 big decision to make. Here is the takeaway. Withdrawals offer flexibility. Salaries bring structure. Both have advantages and disadvantages. But what matters most is paying yourself on purpose and with a plan. Do you want to make the right choice for your business? Grab your free Pay Yourself guide in the description below. It is packed with checklists, examples, and tips to keep your income strategy legitimate, clear, and HR proof. Up next, how to say no without getting side-eyed by HR, because boundaries are the new boss move and your time is not a free resource. Like, comment, and subscribe for more real talk on money, business, and surviving the workplace jungle. This is Unmuted Memoirs, where being the boss comes with receipts and clarity. See you in the next episode. Stay unmuted.